Hi everyone, welcome to our June update. Interest rates have gone back up again, and what we're going to do is discuss the effects that we're seeing on the ground. So, if you're an investor at the moment, you're running, or hopefully running numbers to see if you're able to hold on and weather this storm that's coming. We're being told that we're going to have another 2 or 3 rate rises. The issue that we have with all of this speculation around what's going to happen and versus what's not going to happen is so far the pundits and the speculators have been incorrect, all the way up to the RBA. So the RBA told us, obviously, infamously, that we're not going to see rate rises till 2024. So we have to have a look at our numbers, and we have to have a look at the returns that we're getting from our properties and our investments, and seeing worst case scenario, can we hold on? Because let's hypothetically say that we get more than 2 or 3 rate rises. We're not going to be able to blame Philip Lowe for our woes. So we need to be able to plan for the worst and hope for the best. At the moment, we're fielding a lot of phone calls from clients who are stating that in some cases they are up shit creek without a paddle. I get a lot of phone calls from people who are calling me because they feel that their previous broker has let them down. But then we run the figures and say, sorry, your previous broker is actually correct. You can't move, you can't refinance, you should consider selling. Concerns that I have moving forward, I feel spring and the months after spring might be a shitstorm. And here's why. There are a lot of people that I see anecdotally within our business who contact us who are barely hanging on. They're either barely hanging on to their owner occupiers or they're barely hanging on to their investments, but they haven't made that pragmatic decision to let go yet. As the rates keep going up, that screw's going to tighten, and eventually they won't have a choice. Now, the pragmatic people are letting go now, and I applaud them for that because it's a very difficult decision. But you need to remember that you'll have other bites at the apple, so to speak. So if you look at it like that, you should consider selling depending on where you are, depending on the loan value ratio, your debt levels, and your income. You should also take into consideration the possibility that if you do lose your job, what does this mean for your investments and your owner occupier? Can you hold on? Do you have a buffer? These are all very difficult questions. They're hard to face, but I would highly recommend that you do look at these things. Put it into an Excel spreadsheet. It takes the emotion out of it. Hopefully you can make a pragmatic decision. If you're an owner occupier and you're thinking, well, my rate's going to go from 1.9% up to 6%. There's no way I can hold on. And my fixed rate's not coming off until another 6 months. I would recommend that you look at selling now. There are a lot of people who are coming off these fixed rates. You don't want to be competing with them when you're trying to sell your property. So you need to and a hard look at your investments to make sure that you can afford to hold on. If you can afford to hold on, I would say do so. But if you can't, I would say make that decision quickly. It's in your own best interest. If you're an investor, now's the time to start looking at the returns you've been receiving off that property or those investments and see if they are doing you a disservice or if they're assisting your financial future. If you bought it in the last year or so, I would recommend that you have a strong look at whether you can afford to hold on. I'm hoping that you can, okay? Markets are up and down. Doesn't matter what asset class you look at. It's never linear. So you do need to be able to weather these storms, whether it's now, whether it's 4 or 5 years in the future, whatever the case may be. I would recommend that you try to weather these storms as much as you can. But I would advise that you adhere to being pragmatic and looking at the numbers and making decisions based off fact rather than emotion. So what do we expect to see moving forward? I personally expect to see a recession. I expect to see job losses. I expect to see more interest rate rises. And I also expect to see a lot more stock hitting the market. So with that being said, now is the time for you to have a serious think about what you're going to do moving forward. And I would be speaking to professionals. I'm not just talking about mortgage brokers. Talk to your financial advisor. You can definitely reach out to me and I can share some data. There's a lot of information actually from data analysts in this space. Their information is a little bit dry, but I would recommend that you check out Digital Finance Analytics on YouTube. There's a gentleman by the name of Martin North. He has data across all of Australia. He has and tracks by the suburb where there's delinquency in property repayments, moratoriums. He's tracking who is behind their repayments 1 month, 2 months, 3 months. So you can see for yourself what's actually going on rather than listening to Sydney Morning Herald or Daily Telegraph, etc. I'm signed up to newsletters from real estate agents all across the country, whether it is Mossman, St. Mary's, etc. in Sydney. And I can tell you a conversation that I had where I saw a newsletter come out from a real estate agent, and there was 4 houses in the same street for sale. And I called that agent just to find out what was going on, and he told me they were all mortgagee in possession sales. So there is a shitstorm coming, pardon my French, and we do need to batten down the hatches and weather those storms. But once again, I also want to say that I do think that it's going to be a two-sided marketplace when it comes to property prices. There are going to be the suburbs where the well-to-do suburbs where loan value ratios are low, people are not leveraged heavily, and they will weather this storm, or people who have access to capital. If you have access to capital, you can transfer that capital onto your debt with a few clicks of a button and weather that storm. Now, if you're both PAYG and your household income is sitting under 200K and your debt levels are 7 or 8 times that, you're going to be in trouble because your property price is going to go backwards. If one of you loses that income, you're going to face some headwinds. I don't like to scare people, but what I do like to do is at least share what I'm seeing on the ground, the information that I'm collecting. I don't want to just sit here and regurgitate RP data information or CoreLogic information. I'd rather tell you what I'm seeing from my network of agents and what we are seeing on the ground in terms of what vendors are doing and how they're reacting, and also what buyers are doing and how they're reacting. Okay, that's pretty much it for me today. If you have any questions, please feel free to reach out. I'm more than happy to have a chat with people, even if it's just a general conversation. And I'll see you next month.